Hi, Sanat. Good morning.
Good morning, sir.
Good morning.
Hi, good morning. Okay, so let's first summarize what will be covered in this chapter, because first I'll simplify things for you for the entire chapter and then we will get into the details. Okay, so in the first chapter, we obviously just got a fair deal of an idea of what financial statements are and what are the sources of information and what is the process of financial statement analysis, right? In today's chapter, uh, the idea is how do you analyze the financial statements? So that's what the title of the chapter is. Okay. But I'll tell you what is expected in this chapter. Okay. So first is the general principles. Okay. So general principles of revenue recognition. So I'll tell you, also give you a background on this, why exactly this chapter is there. But for now, let's just summarize it. Okay. Then the general principles of expense recognition. Okay. Then the third topic, which is a part of this chapter, is non-recurring items. Okay. Things which do not repeat or are one-off events in a financial statement. Then we will have the EPS calculation. And finally, there is common size analysis. I'll give you a background of this, but let's just write it down on what exactly is expected in this chapter. Okay. So these is basically LM02 of FSA. This is the core expectation of the chapter. Most of the questions will come only from this. So there is a lot of other content, obviously, revolving around it, but this is the major thing, right? Now, why are we learning general principles of revenue recognition? Because we should know the difference between when the revenue gets recognized versus when the cash is received, right? So if you are selling a product, or if let's say a company is selling a product or a service, because there can be various different scenarios of revenue recognition, right? Because it's always not straightforward selling a product. Sometimes it is, let's say, software as a service. So in that case, how do you recognize revenue, right? If there is a bill and hold arrangement in which you make the payment, but you tell the manufacturer or the producer to hold the delivery of the product. You don't deliver it into my, you can say the premises, because maybe there is some requirement of space or whatever, right? Then there is obviously revenue recognition in case of long-term projects, for example, real estate, right? So in these cases, the project takes time to complete, right? So in those cases, this comes under long-term projects. So we as an analyst are or should be aware of what is the accounting, regulations behind this, and this majorly comes under IFRS. So IFRS, we remember we discussed in the first chapter that it is the international financial, the major accounting standard across the world, right? So a lot of this comes under IFRS 15. You don't have to remember this number. I'm just giving you for the sake of the information, right? So it comes under IFRS 15, and it has given certain, guidelines on when you can recognize revenue, right? So very important. Uh, from the perspective of, when you're analyzing a company for, let's say, investment, you're always looking for the conservative approach, in the sense the company which is not very aggressive in revenue recognition. You want conservative approach, right? You want the company to use the more stricter method of revenue recognition rather than using, probably a very aggressive. For example, in case of real estate, you don't want the company to recognize the revenue too fast, right? That would just lead to accounts receivables. Similar case is with expense, right? So here we will understand the matching principle. Okay, the matching principle of expense, right? Non-recurring items, for example, let's say there is discontinued operations, things which are one-off. Sometimes it might happen, right? And what to do with it. And then there is EPS. The reason why we calculate EPS is for example, company usually does not have a very simple investors, right? They might have ordinary equity shareholders, the ones who buy the common shares, but they might also have preference shareholders. The company also might go and take a debt from the market and then come up with a structure where the debt can get converted into common shares. So in common nuance or language, we call that as dilution, right? Because if you have 100 common shares, okay, ordinarily, and then there are 10 different kinds of shares which can get converted into common shares, then the earning per share for the normal shareholders, right, the ordinary shareholders, will get diluted. That means EPS will go down. Okay, so we'll come to the calculation of that. And finally, common size analysis, because generally when we are analyzing expenses, okay, practically speaking, this is more used for expense forecasting. Later on, when you will, if in case you have made financial models or you intend to make financial models, then you will realize that most of the expensive forecastings, which are indirect, is done as a percentage. Okay, so this is nothing but as a percentage of revenue. So that is nothing but common size analysis. So that is the basic expectation in the second chapter, right? So first, let's get started with the major rule. I hope this is clear till here.
Sir, I would just want to ask a question.
Sure.
Sir, basically, if a CFA does these things, then a difference between financial analyst, CFA, and business analyst, how can we differ those?
Business analyst is a very different role. Okay. So as a CFA, as a financial analyst, you are not really making these things. Okay. So you already get the annual reports. And your objective of knowing this is so that you can discern whether the company is actually, see, because look at it like this. Okay. So if let's say we're talking about Titan, it's a publicly listed company and you are the investor out here, right? So as an investor, we already, looked in chapter 1, what are the source of information that I get? So in the public domain, right, what information do I have? I have information of annual reports, quarterly reports, right? And some, third party information. But I do not. So this, who is making this? All of these. So this is the chartered accountant or the CA firm which Titan hires, who makes this. Of course, that is audited by a third party auditor, but still, that third party auditor is also getting paid by Titan, right? So all of these statements are made by the chartered accountant. Now you think about it. If a company has hired a CA in order to make these financial statements, of course, no matter how honest the company might be, the idea is to show your investors, because this is the investor, right? So you want to show, obviously not worse information, but good information, right? You want to show a good rosy picture. That is what, as an analyst, we are thinking. So we do not get access to the bills and vouchers that the Titan has sold. We are directly getting access to the final result, which is the financial statements. So whenever such financial statements I'm looking at, I need to know at a general level what are the various principles that have been followed and where I can question the management or where I can understand that the company is probably becoming very aggressive. Now, this is the financial analyst job. Okay. Specifically in investments. Now, business analyst is very different. Business analyst is when specifically talking about a product-based company. Okay. Maybe it is product-based company or it's an IT company, doesn't matter. It's a service-based company, doesn't matter. So product-based company is trying to find clients. Okay. So let's say the client is Salesforce. And let's say the product-based company is, let's say, Zoho. I'm just taking an example. Okay. Now, the client has some requirement, and the product-based company or the service-based company obviously has developers, right? So the technical guy cannot understand business, right? Because when the client is coming, you are not really getting the IT developers who are coming and talking to you. It's basically the business which is coming and talking to you, right? So the job of the business analyst is to understand the requirement of the client. So the BA guy actually has some technical background, but he also has some business background. So he's a combination of both. So he understands the requirement and then communicates it to the developers. And I mean, so and so, right? So any requirement from here, it communicates to the client. That is a very different role versus financial analyst. So as a business analyst, you're basically working inside the company. In fact, Titan might have a business analyst inside the company. But as a financial analyst, you are external. Understood?
And sir, as in CFA, what does what is its job role?
So the job role is this only, na?
Financial analyst.
Financial analyst, let's say you're working with a broking firm. So you would analyze stocks, companies, right? Create financial models, create research reports, and use these reports to get more clients for the broking firm. That is one of the jobs, one of the job roles of an analyst, right? The second could be, just give me a second. Okay. That is one of the roles that a CFA can work for. Then the other is if you are, let's say, working with an AMC, asset management company. Okay. So let's say it is so many asset management companies are there, Franklin Templeton, right? You've got HDFC mutual fund, and you've got let's say ICICI. Now out here, there is a pool of capital. There's capital out here. And the capital is coming from large amount of public investors in very small amount. Okay. So the capital is coming from here. And of course, they expect returns. So in order to manage this capital, right, you will have analysts, right? And there will be analysts as per the scheme of the mutual fund. So Franklin Templeton is not one entity, right? It has got various schemes. It has got large cap, small cap, fixed income, cash management, balanced, hybrid. So many schemes are there. So there will be a team of analysts out here, which is headed by a fund manager. Okay. So multiply this with, let's say, 10 teams like that or 20 teams like that. On top of this, you usually do not have a CEO in case of a asset management company. You have a CIO, Chief Investment Officer, right? So this is also a place for a CFA to work. This obviously you progress to the ranks and you can get into this. So this is one, right? Let's also talk about now. This is directly managing the money. So this is actually called as buy side. Okay. The previous one which I showed, this This is sell side. Sell side because I'll tell you why. So these analysts, right, would require research reports. So the sell side analyst, okay, would actually come and present the research reports to this guy, the buy side analyst. And if he likes the research report, basically you've reduced his work a lot. So in return, what he will do is he will give you trading. So he will trade with you. So you will basically get commission, right? So that's how sell side and buy side works together. Now, let me actually write it down here only so you understand. Now, this capital also somebody has to get, because people don't usually just go to a website and pay the money and all all is well and good, right? So you've got large wealth management firms. Okay. So huge. In fact, a lot of wealth management firms probably might be bigger than a lot of mutual fund companies, right? So the wealth management firms are very good at client acquisition. So client acquisition and servicing of clients. Okay. So out here, think about it. Okay. Here you're running various schemes, right? So you've got large cap, you've got small cap, you've got mid cap. So you're basically just managing a scheme, right? For a wealth management firm, they have a larger problem to solve. The firm has to solve the problem of asset allocation. This is what CFA is all about. Asset allocation is a big issue, right? Because, for example, in my case, let's say Alan, and there's my friend, let's say Shashank. Now, Shashank is in a job of senior guy, let's say he's a CEO, and Alan, for me, let's say I'm in business. So the wealth management company is basically solving my problem of how much should I put in equity, fixed income, alternatives, right? Let's say crypto, whatever you want to call it, how much cash should be kept. All of this is decided on the basis of my goals. So now, if let's say the wealth management company cannot come and tell me to put a lot in equity, why? Because I'm already in equity, remember? I'm already in business, and business is equity. So if I start putting more money in equity and I'm already running a business, when the equity markets will fall, my business is not going to be saved, right? My business also will fall. So the opposite has to be done. In my case, I need to be high on fixed income, low on equity, medium on cash, and probably high on alternative investments, because alternative investments will give me that protection, because alternative use investments like hedge funds, real estate, gold usually have an inverse correlation with equity. So the idea is to get zero correlation between these assets. So zero correlation basically means that none of them are dependent on each other.
So basically, this is all about diversifying the portfolio, right?
Maybe diversified. So that again, so somebody might say, give me a very nice. So the price for diversification. So it's again inverse. So this is how it works.
Okay, diversification is equal inverse of returns. Okay.
First, right? Because the more, so why are you diversifying? Because you want to lower the risk.
Yeah.
If you're lowering the risk, you'll lower the returns. But
Mm,
you're trying to lower it in a highest risk adjusted. That is why we talk about highest. This, when you
interesting.
learn
Yeah.
count, it will be very, very fun to understand that when we're saying diversifying is not just about putting 20 stocks.
Okay. So like investment diversification.
Yes,
It's
highest risk adjusted returns.
risk adjusted. Yeah.
Risk adjusted means, I'll show you something. Okay. So, for example, this is the graph.
Mm,
Okay. And let's say we are saying this is the returns
mm,
and this is the standard deviation. That means risk
risk.
deviation from the mean.
Mm,
Okay. So the idea is that if this is the curve
Hmm.
line, right? So I want to be on this line because this is the optimal line, right? Because at every risk, right, I am getting the highest possible return,
Hmm.
right? Uh, and I can keep on going, right? And I can keep on increasing the standard deviation. So let's say this is standard deviation at about 45%, 45, let's say, okay,
Hmm.
percentage. And this is at 30 and this is at 15,
Okay.
right? So lower risk. So maybe I
Lower
can
return.
target 10% return. Let's say out here I can 20 and let's say 30. Now the idea is that highest risk adjusted means to scientifically calculated in such a way that I'm actually on this line. Most of the people that diversify on their own, thinking that they have actually diversified, might actually taking the same risk, but might be somewhere around here. So this is what is the result of you can say lack of knowledge or lack of
So basically,
expertise.
not iterating to get like, what is the maximum possible return over here?
Yes. So
Okay.
it is not possible to keep on having higher returns without obviously increasing risk, but it is
True. True.
possible to have the highest risk adjusted returns,
Hmm. And this
right?
is what the analysts are doing, especially
This,
the
so
financial
this,
analysts.
this is towards wealth management.
Wealth management.
This
Correct.
is the actual wealth management, which if you, in fact, 70% of the CFA charter holders
Hmm. Hmm.
work in wealth management
Wealth management. True.
because that is where the money is. And you have power. The reason why you are in wealth management because you have power, because you can control how you work with the AMC. The AMC actually does not have a lot of power.
AMC as in what is
The
AMC?
asset management company
Okay.
or
Okay.
mutual
Okay.
fund. Like the fund does not have a lot of power because I am controlling the capital.
Hmm.
So if tomorrow I'm not happy, I'm gone. Right.
Yeah.
So in fact, people usually in India or a lot of places do not consider this as a very good option because they think that they have to do sales and it has a lot to do with relationship management.
This is the job that gives you a lot of stress and white hairs. Come on, Ellen.
Yes, right. But if you want if you want success,
If you want to make money in a short period of time, this is the place.
long term also, and plus you will also have the option to, as you work towards many years, you tend to make a client base.
And
And
this is one of the jobs where you will never retire.
yeah, never. Yeah, exactly. And plus you get to learn a lot and you get access to investors. See, the main
Correct.
question is you get
Networking.
access to huge investors.
Hmm, hmm, hmm.
Okay. And I've seen personally a lot of small time distributors of mutual funds in India who were very serious about their work. In 10 years' time, they've grown, I mean, incredibly, right?
Hmm.
And at the same time, if you see an analyst, probably if he's a good analyst, it's a good thing. So see, as an analyst out here, let me go back to that slide. So as an analyst in a AMC or in a broking firm, you have to not, you cannot be in that mentality that I'm just going to be behind a screen analyzing stocks.
Hmm.
If you start with that mentality, then you are obviously going to get stuck in this career. You will not get growth. You might get growth up to, let's say, 20 lakhs CTC as per Indian standards, or maybe outside at another level. But beyond that, you will not get. So you have to start from the perspective that if I am going into the buy side, then
Hmm.
I want to become the fund manager or the CIO.
Hmm.
That is the objective, right? It's not necessary that you have to always become a fund manager only for mutual fund. You can also become a fund manager of, let's say, a small size, let's say a hedge fund.
Hmm, hmm, hmm.
A lot of possibilities are there, right? If you are starting in sell side, the objective should not be just to do sell side research. It has to be a investment banker.
Correct.
So see, the sell side analyst has to start with that mentality that eventually, using this experience, I'm going to go in the market and I'm going to do the same thing with mergers and acquisition
Hmm.
or with private equity because ultimately it's all about sales, right? So in even in sell side analysis, so the reason why I'm saying sales, but here, even if you want to enter sales, you cannot enter because you are in investment banking, you're dealing with, founders of companies, you're dealing with, international investors, you're dealing with HNIs, right? High net worth
And
individuals.
network individual, yeah.
So you need to know some content. I mean, you need to know something about businesses, right? So,
And not only the business, it's the entire ecosystem of that business, how it is
yes.
working, what are the trends, market
So
scenario.
all of these jobs
Hmm.
are open and these are huge. I mean, I've just pointed out at a very, very summarized level on what are the opportunities.
You just this is entire chapter takes like 2 days to understand this capital markets itself.
Yeah,
It's a very extensive course.
of
And
course.
by the way, we have been looking for a chief investment officer for like 10, 11 months now.
Acha,
Yeah, we have not found one. So basically, I'm working with a government state-owned oil company here, and
right.
our business is into shipment of oil and gas across the
Okay.
world.
Okay.
So we have a team of CFAs who
Mm,
are doing a lot of research to bring in assets to merger and looking for opportunities to merge and acquire assets that are into shipping and EPC.
right.
So they are the ones who are building the financial models, they're reviewing the market, they're looking at the trends and what value this business is going to have for us.
Of course.
So in long run, what are the returns and how it comes to NPV, right? If we acquire it.
Right.
So what is the present value of that benefit? This
Right.
is what they are doing. And then when
So,
when
so
it comes
that's
to
what. So now you can also get into those works without a CFA. But see, in my experience, what it has been is there's no other qualification which gives you this. See, now all of these things I told you, right? Right
Hmm.
now. So if you start learning through, let's say, an MBA plus some books reading, it's all scattered.
Yeah.
CFA, what it does is it combines all of that in a simple three-level programs, and then you don't need any other qualifications after that to understand investments. In fact, people do FRM and CII just for the sake of it, fun of it. But whatever background you wanted for investment careers, okay, and also probably managing your own money, and also probably it gives you a very good perspective in managing your business,
Hmm.
right? Because you understand now, you are not blind, right? And you will never have that question again, but you have to target to complete all the three levels. Okay, because the fun is in level three when it all comes back and it is about portfolio management. So right now we're just learning tools. It might sound sometimes overwhelming on the kind of details that we get into,
Hmm.
uh, probably when which we have not even read somewhere. But then all it comes out when we are thinking about in the wealth management and the portfolio management side. Right.
Hmm.
So, Sanat, I hope this is clear,
Yes, sir.
right? So, plenty of opportunities are there, and the general respect of the qualification is also very high. Okay, that is, this is one qualification which has not, in my opinion, uh, reduced or diluted its value, which is very important. I'll tell you why. Probably this gives you some motivation also to stick around, right? So, you might have heard about ACCA, right? So,
ACCA, CPA, all those.
CPA is still good.
Hmm.
Okay. Uh, you might have heard about CFP as well, right? You might have heard about CMA, any other, yeah, maybe CWM, whatever, right? All of these international qualifications, what they've done is in the market, eventually, as soon as they entered India, what they did is they started chasing numbers. Okay. And they came up with complex structures for exemptions. So, for example, there's a graduate in India, you get 6 paper exemption. You're an MBA, you get 10 paper exemption. Same thing, this guy also did. Same thing, they also did. Same thing, they also did. And same thing, this also did. So, what happened is the whole value of these qualifications in India could not translate into opportunities, right? Opportunities, when I say it is in terms of jobs. So just do a quick Google search on if any job specifically mandates any of these qualifications. You will find none. right? And on the other hand, what I appreciate, okay, this is my appreciation towards CFA, that they've stuck around with the vision. Whether you are a PhD, whether you are a master's, whether you're a graduate, whether you have 10 years experience, 25 years experience, there is no exemption. Everybody goes through the same grind of L1, then L2, and L3. Okay. So I remember when I was giving my L1 exam, that is way back in 2012. And my center was actually in Mumbai. And it was a very overwhelming experience because, so many people were there at that time also, right? And I actually recognized one of my probably person sitting next to me, who was actually a fund manager himself. He is also giving the same exam, right? And so there was no exemption for anyone. IM guys were coming and giving the same exam. And that's why probably, in my opinion, today, when you go and search any jobs, investment related, you always find this, education qualification, mein, they will write it like this: requirements, tier one, then there is, CFA, or there is CA. So that is commendable, in my opinion, to maintain that kind of reputation in the market. And I hope that they continue doing that, uh, because, I mean, finally, the qualification is as good as the value it creates, right? So that's about a little offbeat discussion on the qualification, right? Now let's come back to the revenue recognition. Now, before revenue recognition, because I'm going to assume always that people are coming from zero background. So let's first briefly discuss uh, the three financial statements. Okay, this used to be a chapter in the CFA curriculum. For some reason, they removed it. It used to be called as the financial reporting mechanics. So in my time, this used to be the chapter. Okay. So although this chapter is no more there, but I feel that this is very, very important for us to get a start with the statements, specifically people who are not coming from the background. Okay. And anyways, it doesn't matter because even when I learned it, it was new for me, right? So income statement, then we got balance sheet, and then we got cash flow statement. What we need to first understand is, how are these three statements actually linked? Okay. In the first lecture, we obviously discussed on the purpose of these three financial statements, right? So income statement is for performance for a specific year. Performance in the sense, whatever, revenue expenses for a particular year. Whereas balance sheet is cumulative. So it is, you can say, performance till date. So this is performance for a year. This is cumulative performance till date. And this is basically, you can call it in short term as a reconciliation statement. Call it as a reconciliation statement, because income statement and balance sheet both are using accruals. That means they are not always about cash, right? It is not cash, because that is why we are discussing revenue recognition, right? So this cash flow statement is basically helping us to get rid of the accruals and actually get how much money did we make in terms of cash. Okay, so this is the idea that we already know, right? But how is it linked, right? So let me draw a very simple income statement, balance sheet, and cash flow. Okay, so let's start with revenue. Okay, so revenue can be either sale of products or sale of service, doesn't matter, right? So revenue, and then we reduce. So first and foremost, the thing to reduce is which directly is the cost we incurred to generate this revenue. Okay. So if it is a laptop manufacturer, right, then the cost of those parts which we bought to make that laptop is the direct cost. So we're basically talking about direct cost. Okay, these are not the actual terminologies, but I'm using it so that you understand. So direct cost to generate this money, which is also called as cost of good sold or cost of service, whatever you want to call it, right? Now, when you reduce this cost, direct cost, you get gross profit. Okay. Now, just for a second, just pause here and think about companies, that if a company's gross profit is small year on year, if I compare 2 years, what could be the reason for a company's cost of or gross profit to reduce? If, let's say, the cost of material has increased, direct cost. So if we are making, let's say, EVs, right, electric vehicles, and let's say the cost of lithium increases in the market, right, or let's say any other material which is probably very critical for that business, then my gross profit is going to reduce. That's why we also talk about gross profit margin. And whenever we hear gross profit margin, we should think about direct costs. Okay. Now, after this, once we've got, so let's say we had 100 and we had a direct cost of 20. So now you have a gross profit of 80. Once the direct cost is done, now we are ready to deduct the indirect cost. So think about running any business. What are the costs which are not directly related to generating that revenue? It could be salaries, it could be rent, it could be marketing, right? It could be maintenance, etc., right? So when you also call this together as selling, general, and admin. Okay. So indirect costs. So now again, think about a company which, if it is spending too much on marketing, and you'll specifically see this with a lot of startups nowadays, right? Which have gone through the private funding side, like Zomato or Blinkit or Baiju for that matter, right? These businesses did not function well because they spend huge money on indirect cost. And this directly brings us to that number, which is very, very critical for a business, which is called as EBITDA. Okay. The full form is earnings before earnings before interest, tax, depreciation, and amortization. Okay. We also call it as operating profit in India. Okay. I'll tell you why. So in India, we generally are talking about EBITDA as the operating profit. Okay. In US terminologies, as an analyst, if you're working with US companies like CRISIL or you are serving clients like Credit Suisse, you would go one step further down and reduce depreciation and amortization and then get EBIT. And this would be called as operating profit in case of US terminology. As per CFA, this is operating profit. Okay. Now, just hold on a second before we go down. Okay. So EBITDA is the operating profit, and EBITDA margin is whether you win the game or you lose the game. High amount of businesses go out of business just because of a lower operating profit. Please remember that. Why? As I told you, if you start taking unsustainable expenses out here, like you are paying huge salaries, you are taking up new places which are very high on rent, and you're not looking out for opportunities of reducing your costs, if you're spending huge on unsustainable marketing, eventually what happens? The margins of EBITDA margins will drop. Now, as a ballpark number, remember that good businesses will have upwards of 20% EBITDA margin. Upwards of 20. That means for every 100 rupees in revenue, okay, at the operating level, at the operating profit level, we should have 20. Because if we do not have this 20, that we cannot take the shocks of the changes in the market. There might be price changes, there might be policy changes, there might be tariffs. So if a company is not even having a 20% margin, then in the longer run, the business is not even scalable, right? So now, coming back to EBITDA, okay? So earning before interest, tax, depreciation, and amortization. Now this depreciation, what is this depreciation? Now this is where we jump into the other financial statement. Where is balance sheet? So in the balance sheet, okay, you've got, usually even in our lives, we have either assets, okay, and then we have liabilities, and then we have our own money which we have invested. Okay. So think about all the assets that is there in your lives, right? So cash, starting with cash that you have in your bank account is an asset. The car that you have is an asset, right? Let's say if you have investments on other companies, mutual fund investments, all would be assets. Debt is a liability. If somebody owes you money, or you owe money to someone, that's a liability, right? Equity is when you're contributing your own money in the business. So let's say Mentomy career. So in order to start, even form an LLP, when you form an LLP, initially, you have to add some capital. Otherwise, legally, you cannot even form the LLP, right? So initially, you contribute 50,000 and you call it as contributed capital, right? Because if you're forming an LLP, you need to start with some capital, and that's why you need a bank account, right? So you put that 50,000, that is called as equity. Now, as an equity investor, so this is business and me, we are two different people. So from Alan, the business has got 50,000. And hence, that's the reason why actually in equity, there's something called as the contributed capital. So that 50,000 that I spoke about, that is the contributed capital, right? So here, okay. Now, when you do that business and you generate more money, right? Obviously, some profits will come in the income statement and that will flow into the balance sheet. Great. What I wanted to discuss initially is the depreciation. Okay. So think about this. Why do we even depreciate? So let's say we bought a car. Okay. Let's say we bought a car worth, let's say 500. Okay. Just for the sake of discussion. Okay. Now we bought a car. Obviously, we can either use our own money to buy the car or we can use debt, right? So let's first see how this is going to work. So let's say we bought the car, and I'm just going to quickly just make a sheet out here to just discuss this. So you bought a car, okay? So car is worth 50,000, sorry, 500. So let's write car. So the assets have gone up by plus 500. The car has gone up by 500. In the balance sheet is looking like an asset. But remember, assets is equal to liability plus equity. That's the balancing equation. Every transaction after whatever it might be, any transaction, at the end, both the sides have to equalize. Okay. Remember that after each and every transaction. So if you bought car, if you bought using your own cash, then the cash will reduce by minus 400 and hence the balance sheet will tally at 0. Agreed? Right? So again, okay. Now let's say we bought the same car. Okay, this is the second discussion I'm doing. Okay. So let's say we bought the car again at plus 500, but let's say we used debt. So we do not use our cash. So on the asset side, we've got 500 increment. So in the liability side, the debt will increase by this 500. Okay. So that's how the balance sheet got tallied. Are we getting this?
Sir, in terms of a company, when you have an asset, let's considering a car which is bought for purpose of company.
Hmm.
Does it consider as an asset or a liability for the company?
Asset
Because it
only.
is.
Asset only, no? We're talking about a company only, no?
Oh,
We're talking about company, whether it's a company, individual, partnership, LLP, doesn't matter.
sir, recently a case of Blue Smart has been opened up. The CFO of the company took the investors' money and put it into an asset. We can say it. He invested those money in buying a property in DLF Camellias.
That is money laundering.
Okay.
That is money laundering. That is nothing to do with balance sheet. Yeah,
So,
it
so
happens.
if
And it happens more often than what you read in the news.
okay,
I'll show you, right? I'll show you examples. But for now, are you understanding the double entry system?
okay,
You're understanding, right?
yes.
Okay, great. So now think about it. So we are talking about the balance sheet. This is the balance sheet, and we bought a car. Okay, for now, let's consider that we used so this is fixed asset, right? And then the cash reduced minus 500 and the balance sheet tally, we are happy. Great. Okay. Now tell me one thing. Whenever we are using the car, this car, are we just going to use it for 1 year? Of
No.
course not, right? Maybe we might use it for 5, but there might be a
Uh,
probable useful life of a car. So whenever we
yes.
buy a car, we might say that, the car, usually, let's say, has a life of 10 years, or depending upon the accounting regulation, whatever it is, right? So 10 years. Now, how do we translate this into the financial statements? Because I cannot just keep the asset out here and just forget about it, right? Because if I do that, then in the income statement, remember, revenue minus expenses is equal to profit is the structure of income statement, right? So if I do not take the expense at all in the income statement, then I'm misstating the income statement, because I'm saying that the car was never used. But if I directly take minus 500 out here for car purchase, that is also wrong. If I put the car purchase here, think about it. Then I'm saying I'm going to use the car only for 1 year. Period. Is that right? Can I say?
Income statement, it is for a particular period of time, right?
Correct. So that means if I just put directly the entire 500 out here, right? Then I'm saying that all of the whole useful life of the car, I've used it in 1 year, which is wrong.
Yes.
I need to take 1 year worth of expense in the income statement, right? And hence, that is where the concept of depreciation comes. Okay. So the order in which I'm teaching right now might not match the curriculum right now, because curriculum obviously assumes a certain flow. And I'm totally going into basics, which probably are required. Unless and until you do understand this, you cannot understand anything, right? So this 500 now, right? The car purchase that we did, let's say this was a Swift, needs to be spread across, let's say, 10 years. So when we are taking depreciation as an expense, we are basically spreading the cost. Okay. So whenever we are depreciating, we are saying spread the cost of the asset. Okay. So 500. So minus 500 divided by 10. So basically we're saying we're just going to take a 50 expense in the income statement for now. Let's say the revenue was 200. Okay. So now we've got profit of 150. Now what will happen in the next year? Think about this. Okay. So what I'll do is I'll just rub this side and I'm going to make assets for the next year. Balance sheet only, but next year. So let's say this is the first year and this is the asset for second year in the balance sheet. Now what will happen in the next year is this 500 will reduce by 50 because we remember you took the expense. So now ending fixed asset is what? 450. Are you getting it? So now why am I discussing this? Remember here, when I was talking about the linkages between the statements, now finally, okay, let me change the color out here. Now this depreciation basically is getting linked to the fixed assets, right? How? Through depreciation. Getting it?
Yes.
Right? Now, you might also think then how is revenue linked to the balance sheet? That also I'll discuss. So let's understand how is revenue in my income statement linked to the balance sheet. Okay. So we'll take some examples out here. So let's say we are selling, let's say, you think about something. We are selling an EV. Let's say we're selling an EV. Okay. So we sold an EV for, let's say, 1 lakh. Okay. Now remember that it might be so that this is either cash or it might not be cash, which means pay later. That means the customer might either use loans, might take EMIs, I don't know, right? So in that case, this is pay later. And if it is upfront cash, direct debt payment, I get the money. Okay. So now let's first consider cash. Okay. So in my balance sheet, again, I've got asset, liability, and equity. Okay. So if cash comes directly 100,000, then simple. 100,000, my asset goes up by 100,000. And right now, see, I don't have any expense out here, right? So I have not put in any expense. I will put, but for now, let's consider that there's no expense and hence the profit is 100,000. Let's say for now. So this net income that I have, net profit that I have from here, okay, again, I'm changing the color so that it is visible. This is not visible. Okay, this is visible. From here, the net income goes all the way into retained earnings. Okay. So retained earnings is a part of equity. So equity has two parts: contributed capital, the initial money that I'm putting in the business, plus every year the profits which come go to retained earnings. So out here, since there was no expense, plus 100,000. So the balance sheet is again tallied. Understood here? One scenario. Second scenario. Let's say the person says that, okay, fine, I bought the product, but I'll pay you later. Let's say after 1 year. Okay. 100,000, I'll pay you later. So now the question is, in terms of the income statement, I will still recognize the revenue because the ether that I was trying to sell has gone to the customer. Okay. So the risk of ownership. So now anything happens to the ether, not my responsibility, is the responsibility of the customer. So there is some proof that the product has been sold. The contract has been initiated, and sooner or later the payment will come. So the risk of ownership is transferred, and hence I can recognize the revenue still. That is why it is called accrual system, right? Because I'm recognizing not on the basis of when cash is received, but when risk of ownership is transferred. So now if it is transferred out here, right? Second scenario out here, but my cash is not received. But since there is zero expense, profit has increased. So my equity retained earning has increased by plus 100,000. But the money has not been received. But the money somebody owes me and they will pay me later. So if you owe to someone, let's say if I owe to Sanat, then it's a liability for me. But if Sanat owes me, then it's an asset. So in this case, the customer owes me, and hence it's an asset for me, but obviously not in the form of cash, in the form of accounts receivable. So plus 100,000 again. So that's how, again, the revenue is getting linked to the balance sheet, which I was talking. So there's a huge linkage between, at every transaction, there is a linkage between the three financial statements, without which not possible. Okay. Are we getting it? Now, what we'll do is, all of this cannot be done, obviously, in a piece of paper. So I hope you guys have an Excel. Do you have an Excel, everyone? Just give me a second. I'll just share you that file. Okay. Please check the chat. You'll see I shared an Excel. Sharing the screen. So this is the chapter that CFA Institute obviously has gotten rid of it, but I felt that this is extremely important, without which we cannot move forward. Okay. Do you have the file? Let me know when you guys are ready, okay? Okay. So we're going to make the income statement, balance sheet, and cash flow. Okay. For obviously a very small scale. But each transaction, after each transaction, manually, the balance sheet and has to tally. That is the target. Okay. So let's look at this as an example. So there's a person out here who has applied for, let's say, an LLP or a company, private limited. And initially, all the three owners have decided to put in 200,000 as the initial capital. This does not mean, people usually think that this means that this is the investment. No, not really. Okay. The investment can increase later on. This might just be the initial regulatory requirement to start the business. Okay, 200,000. to capitalize the company through 200 lakhs. So let's come to the three financial statements. So first tell me whether 200,000 that we're putting in the business, will it go into the income statement or not? And remember that what the income statement was about. Was it about capitalizing the company? Was it about performance? What exactly? Initial 200,000, 2 lakh rupees that we're putting, should it go in the income statement or not? Yes or no? Don't worry too much about whether you will get it wrong. No, because it is not revenue. It is neither expense. Income statement has to be related to sale of products and services of the business, right? Have you sold any business? Have you sold any products? Have you sold nothing? It's just, let's say with all of us together starting a business and we decide, okay, initial business starting, we need to put some capital in the bank. Is this income? Can anybody claim that, okay, this 200,000 that we have put, we'll take some part of it as profits? Common sense, think. No, right? 200,000 is initially just the starting bank requirement that we're putting the money. So it will actually go into the balance sheet. Remember, I spoke about balance sheet. So on the liability side, if you remember this side, I will put is equal to, you don't have to know a lot of Excel for doing this. Okay. So on the capital side, just write 200,000. 2 lakhs, basically. Okay. Now tell me what should be the counter entry. Remember, just for a while back, we were discussing that at every transaction, the balance sheet has to tally. So tell me, what should be the counter entry for this? If equity has increased by 200,000, what could be the other entry which would make both the sides, liability plus equity and asset side, same? It has to same. You can practice this method actually. Capital has gone up by 200,000. Now both need to come at the same level. So what can happen so that these two become same? Come on, come on. Sanat, what do you think? Anuj, what do you think? What should be the counter entry, guys? Come on.
You've got a capital of
200,000.
1,000 and
What
okay.
should be the counter entry? This is the transaction.
This should be cash, right? Like we have
Right.
got a capital, right? So we'll go to the cash.
So cash also is 200,000. And let's put a sum function here. Okay. If you're new to Excel, just use SUM is equal to and just select this entire place and press enter. So that every transaction we can check whether the balance sheet is tallying or not. Okay. And do the same thing on the asset side also is equal to sum and press enter. So you can see that the balance sheet tallies at the first transaction, right?
Okay, you have already put a check function there
Yeah, I
below that.
put a check function so that we can keep on
You
checking.
just ensure that it is zero all the time.
Yes. So
Okay.
this always should be blank or zero. Second, set up an investment account and purchase. Please read properly, okay? Set up an investment account and purchase portfolio of equity and fixed income. So basically you're buying, let's say, some mutual funds, right? worth 50,000. So think about investment, not in the business, external to the business, 50,000. So what should be the first transaction? 50,000 worth of investments. Give it a try.
Investment. So here on the asset side, we'll put that 50,000 here. Second.
Correct? Correct.
And on the liabilities and stakeholders equity, it will go to
Not really.
unearned revenue, unearned accounts payable.
50,000 is the investments that we are doing.
Yeah. So
What is the source of investments? Cash. So reduce the cash minus,
okay. Okay.
right? So investments had gone up, the assets had gone 50,000,
Hmm.
right? And now the cash has to reduce.
Hmm.
So at the same time, the cash reduced by 50,000 and again at the same level.
Okay.
Getting it, guys?
Hmm.
Okay. So if you have to understand this in the longer run financial statement analysis properly, if you just understand the linkages between the three financial statements excellently, I think in the long run it will help you a lot. Just not just clearing the CFA, FSA part, but also analyzing companies and just getting that idea on what is happening is always easy. Okay. Okay, let's look at the next transaction. Purchase office equipment. So similar to the example that I was taking of buying a car. So we are buying an equipment of 10,000. So first let's take care of that.
Hmm.
Only the purchase of 10,000. Okay. So it is not written that we have used debt.
Hmm. So again, cash will go out.
So first we increase the equipment by 10,000
Hmm.
and then reduce the cash by 10,000.
Okay.
Balance sheet tallies. Now the second part of it, which is it says that the equipments have a life of 2 years. And zero salvage basically means that at the end, as per the accounting norms, we're going to consider that the end value of this asset is going to be zero.
Zero.
Right? Uh, Always it is not so. It depends upon the accounting regulation that you're following. Right? So here we are going to, so now if the useful life is only 2 years.
Yes.
So remember what I spoke about initially, that what is the income statement doing? So this equipment I purchased, am I saying that this equipment I'm going to use it only for 1 year? No, right? So I'm going to use it for how many years? 2 years. So let's spread out the costs. Okay, because income statement still has to show expense of the asset, but it directly does not show it here. So I have not taken this office equipment and put it as an expense here, because that would be wrong. That would be saying that I'm going to use the asset only for this year. But since I'm using it for 2 years and this income statement is about 1 year, I'm going to take 1 year worth of expense of the equipment that I just purchased. So is equal to minus because I want to make the calculation easy, or you can just take it as positive. We'll reduce it. So 10,000 divided by 2, right? 2 years. Okay. So now see, now look properly what is happening here. Okay. So again, out here, I'm going to put a formula here so that every time there's a transaction from income statement, okay, it will affect the balance sheet. Okay. So let's just do this. So let's write the formula. Just copy what I'm doing. Okay. So revenue minus expenses is profit, right? So revenue minus sum of all the expenses, okay, excluding other income, because this other income is basically income. So I'll add it. So just make sure that you make this formula first.
Hmm.
At the moment, not looking at various depreciation because that, so I'll tell you this depreciation itself, the calculation will come on the chapter called as long-term assets. Right now, we're just at a very summarized level,
Okay.
right? Okay. So let's press enter. So now you can see here, every time there's a transaction out here in the income statement, okay, we'll get a profit and loss. Now, remember what I told you, where is this profit and loss linked? In the equity side. In fact, you can, if you want to make, I'll suggest you make a separate section and call it as retained earning. So it's easier to understand. Contributed capital and return. For retained earning, just link the profit. So every time, remember the profit is linked to the retained earnings. Okay. So next year, what will happen? Last year's retained earnings, whatever it was, plus this year's profit. That's how it keeps on getting accumulated.
Okay, so this is how you're creating a link between income statement and balance sheet, right?
Yes, yes, yes.
Okay. Profit or loss. Yeah, it has to be reflected both positive or negative, whatever the
Right.
situation
So,
is.
for example, now, since we depreciated the asset, you can see now that the retained earning has reduced by minus 5,000, right? And now in the equipment side, let's come. What was the equipment value?
10,000.
10,000 only, no? Yeah.
Yeah,
5,000. Now let's reduce this minus
5,000.
5,000, right? Now, obviously, there's a misbalance, right? So figure out now what could be the counter entry for this for it to balance. Okay. And while you do that, I'll just be back in 5 minutes. Okay. Sorry about that. So now, I
So
suppose the summation has not happened properly.
shouldn't we put it as accounts payable over here?
No, accounts payable is different. I'll tell you what is accounts payable. There's an example of accounts payable also in this exercise. Okay. So now you can see here, balance sheet is tallied. Okay.
Okay, so that summation was not there. That's why I
The
was.
summation was not there. Yeah.
Okay, sorry.
Okay. Now, pay rupees 5,000 to landlord. So you're taking an office space and you're paying 5,000 for office, out of which the breakup is 3,000 as deposit and 2,000 as advance rent for the first month. So now let's consider that this, whatever we are making it for 1 year or one period. Okay. So 5,000 we are paying. So let's first take care of the first part, which is this. 5,000 is going. So let's take care of that. So how do we do that? Obviously, we are going to reduce cash by minus 5,000. That's the first part. What we do with it is secondary. Let's see. Obviously, the balance sheet does not tally. Right? Now, it said that 3,000 out of this is now deposit. Now, think about deposit. Is it an asset for you or is it a liability for you? For you, when you are paying it.
It's a liability.
Liability.
Who owes you back? Do you sacrifice the deposit forever?
No, no, no. That deposit will come back, right?
Right. So
So,
it is a liability for the owner, no?
hmm.
For me, I have the right to take it back later. So
So
it's an
that's a
asset,
deposit entry.
right? So 3,000 will be deposit. So remember now, out of that 5,000, 3,000 has already been balanced because 5,000 your cash reduced,
Hmm.
right? 5,000 your deposit increased.
Hmm.
Sorry, your deposit 3,000 your deposit increased. Now we just have to justify the 2,000. So 2,000 is again
Advance rent.
advance rent.
Advance rent.
Again, is it a liability for you or is it an asset for you? Think properly. Today,
It's an asset. We are renting the office. We are using it.
right? So, for example, if you were the landowner and you took advance rent from someone for, let's say, 12 months, have you provided the service yet? Have you actually, has the person or the customer actually stayed for 12 months? No.
No.
Remember what the revenue recognition principle said, that when is the revenue recognized? When the service is rendered or the cost of risk of ownership is transferred, right? So we have not used it. So for us as the rentee, the one who is taking the office, it's an asset for us, right? So 2,000 out here. Now please understand that, see out here, if it was not advance rent and it was rent for this month, the month in which we are actually using it, this should have come out here in the rent expense. But it's an advance rent and hence it is bypassing the income statement and directly going to the balance sheet. These are simple things that you need to remember, right? That whichever I'm going to use it for this period comes in the income statement, whichever does not goes in the balance sheet.
Can you just repeat this statement? I couldn't
See,
get
for
it.
example, this advance rent.
Mm-hmm.
See here, look at this statement, 2,000 as advance rent for this month. I have not used it. I'm in the previous month. I'm paying as an advance, right? So in the income statement, it will show current things, not the futuristic things, right? Income statement has to show expenses for this period, not for future periods. For future periods, future income statements will be made, right? So this 2,000 as an advance rent will not come in the income statement today. But when we'll use it, let's say there was another income statement out here. This is one. This is for first year. Let's say there was a second year income statement. Now, in the second period, your advance rent, is it advance anymore?
No.
Then this will come back to here as an expense. So what will happen is advance rent will go to 0. Okay. And your expense as rent will come out here as 2,000. Got it? So things will move. Okay. Are we clear on this? 2,000 as advance rent for this period. In the next period, when we use it, when it is no more advance, okay, it will come as an expense out here in the form of current year rent expense. Got it? This is just for explanatory purposes. Now this is advance in your case when you are selling things. So if you see here, you receive 5,000 as 1 year subscription to the monthly newsletter. So let's say you are also providing in this business, you are also providing some form of magazine subscriptions that you're selling. Okay. Now, you have already received 5,000 as an advance. Now you tell me whether this is an asset for you or a liability for you. First, let's just discuss whether it's an asset for you, whether it's a liability for you.
Asset.
Right. Huh?
Sorry. The thing has not been delivered to the customer, so a kind of
You are
liability.
liable to provide the 1 year subscription. So
Yes.
liability, right? So that will come as a liability in the form of unearned revenue. See, earned revenue will come here directly, in which you have already transferred the goods. Whether or not you have received the cash, you'll still get it. But in this case, you have not just got an advance, right? So what is the advance? 5,000. So now tell me the counter entry also. So unearned revenue goes up by 5,000, but the balance sheet does not tally. So what is the second step? Counter entry. Remember, liability has gone up by 5,000. So something has to come up or liability has to go down in order for it to balance. Is there any scope of liability coming down in case of unearned revenue? Correct. So the cash will go up. Remember, you just got cash, right? Irrespective of it, whether it was advance or not advance, you got the money. So balance sheet tallies. Now let's come back again. Let's see. Now, this is where we will understand how the income statement is linked to the balance sheet in case of cost of goods sold and inventory. Okay. So pay attention now, specifically now. Okay. So purchase and receive. So consider this as an inventory. Okay. We're purchasing 1,000 books at a cost of 50. Okay. Out of which 50% for this cost we are paying in cash and the 50% we are paying later. So first, let's deal with the first part. Purchase and receive 1,000 books at a cost of 50. First, tell me whether this should go in income statement or balance sheet. You're going to eventually sell this book. And initially, you're buying 50 books at 1,000, 1,000 books at 50. So will it go in income statement or balance sheet? Remember, income statement is about periodic revenues and expenses, right? Periodic for a specific period, 2025 or this month or this quarter or last year, right? So should it go in the balance sheet or should it go in the income statement?
Balance sheet.
Correct. Right? Because we have not sold it. Remember, we have just purchased it. Right? So since we have purchased it, only it will go to inventory. So 1,000 into 50. So 50,000 worth of inventory has come in our asset side. But remember now the second part of it, which is a little complex because half we are paying in cash and half we are paying later. So what we pay later is accounts payable. Okay. What we pay later to our suppliers is accounts payable. That's why it's written accounts payable. Okay. Accounts receivable means somebody owes us. So for what we are paying, if we have a payable to someone else, it is a receivable for him. Okay. So let's create that. First, let's obviously reduce minus 25,000 because half of it is obviously paid through cash. Right? So you can see here the misbalance is basically on 25,000. So accounts payable is which side? Liability or asset side? Liability side. Right? So here you can see accounts payable is 25,000. So see, when we bought the inventory, there's no effect on the income statement at the moment. And this is where the second chapter of the financial statement analysis talks about the matching principle. Remember what we spoke about initially when we were summarizing on what will be covered in this chapter is the recognition of expense. So when are we recognizing the expense? When there is an associated activity which is going on for a particular period. So if we are actually using the place for rent, then the rent expense is coming here. when we are going to sell this inventory, that time this expense will come in the income statement. That is nothing but, or depreciation for that matter. When initially it is going to the balance sheet, but when are we using? When are using the asset, that's when the expense is coming on the income statement. So this is nothing but the matching concept. Okay. I'm just giving you a bit of CFA terminologies also, so that when we go back to the curriculum after this exercise, we can make out what we are actually doing. Okay, so we've done the funding part of it. Accounts payable is done. Now, spent rupees 2,500 as an advertisement expense. So should I put it in the balance sheet or should I put it in the income statement?
Income statement.
Because related to specific period, right? So you might run Google ads, but for a certain period. Now there can be a debate on this from an accounting angle, that we might debate that even if we spent, let's say, 2,500 on advertisement for a particular year, does the benefit really only happen for a year? It might happen for many years, right? But that's where the accounting rules are very gray on this area, right? It's impossible to attribute the benefit of certain expenses over time. Okay, so 2,500 as an expense, taken it. Now, what should be the counter entry? So see how it has worked out. 2,500 has reduced your profit and loss by 2,500. It has reduced your retained earnings minus 7,500. And now I need a counter entry for it to balance. Can you tell me? How have we paid this 2,500?
Cash.
Reduce the cash. Right? Making sense till now?
Yes.
This was the chapter that CFA Institute actually took it out. I don't know for what reason, because I don't understand without this how a person can understand. A lot of people coming from commerce background cannot understand. So this is what I usually do in this second chapter. So before I move forward. Okay, now took a loan of 20,000 from a bank for working capital. Let's take the first part of, let's solve the first part. You've taken a loan of 20,000. Where should I put it? Liability or equity? Liability, equity, or asset? Obviously, one, the liability will come only because 20,000 loan I've taken. But what could be the counter entry? What increases? Don't think too much complicated. Whenever we take a loan, what happens to the bank account?
Cash increases.
Correct? Bank is cash, right? So again, okay, what happened? Then minus. Shall not reduce that. Okay. So we've taken a loan and we did that. Now interest is payable. See, interest is payable. We have not paid. So interest payable is 10% and the loan is to be repaid after 2 years. So repayment will take care later, but interest is payable. So when we have to, let's say we're talking about the entire year, what would be the interest for this particular loan that we have taken? 10%. So 2,000, right? So it would still qualify as an expense even if we do not pay it in cash. Okay. So it has to come in the income statement. So this into 10% would come as an expense. Now, whether we pay it or not pay in terms of actual cash will decide whether it will go in liability or equity or the cash side, asset side, right? So since it is written already that it is payable, accounts payable, interest payable, salary payable, all of this means that we have not really paid cash and we'll pay later. So all we'll do is just put that 2,000 out here. and the balance sheet will tally. Right? So see how this transaction affected. Your interest expense reduced your retained earning by 2,500, right? And at the same time, since it reduced by 2,000, your interest payable increased by 2,000 and the balance sheet tallied. So every transaction, the balance sheet has to tally, without which it cannot happen. Okay. Now the loan we have taken care, and now this book that we bought 1,000 books at 50. Now we're gonna, okay, so I'm just gonna color this so that it's easy to understand. Okay, so now we are dealing with the books out here. Okay, the books, 1,000 books that we bought. Now sell for cash 50 at 75. Let's deal with the first part. Sell for cash 50 at 75. So let's go and increase the cash. Remember always when you're dealing, especially, I mean, it's not a financial modeling class, but still I'm just giving you the tip. When you're doing such calculation, please put a bracket. Okay. So 50 books at 75. Cash has come. Okay, cash has come 50 into 75. Now, you've sold the book. So can I recognize the revenue?
Yeah.
Right. Because the risk has been transferred. 3,750. See now how it is affecting. Your 3,750 increased your profit. It was more negative. Now it is less negative. Right. Affected the retained earnings. And parallelly, your cash increased by 50 into 75. Right. Now, second part. Now, let's deal with the second part of this. When you're selling the book, your inventory should reduce.
Yes.
Yes.
So now you've only sold how many books? 50 books. What was the cost price? 50.
50.
So let's first reduce the inventory by 50 into 50. Now see, this is what is the matching concept. Now you first sold the book in the income statement, and then this expense, the inventory, when it's reducing, the inventory reduced, right? That is when the cost of goods sold will come here. Cost of goods sold. You sold the 50 books. The cost of it will now be recognized as 50 into 50. So it is, so inventory is now linked to cost of goods sold when we are selling it, not when we are purchasing it. Now the last part, sell 25 books. Now the rest of the books which we are selling is 25 books at 75. So again, please look at first, the payment is due. That means we are not receiving cash. Okay. So 25 into 75 is the revenue. Revenue I can recognize, remember? Risk is transferred. Right? The customer is taking the books and gone.
Okay. Revenue we are recognizing, but again it is
Receivable.
receivable, yes.
Right? They're not receiving cash. Otherwise, cash would have increased. Right?
Okay, accounts receivable column, yes. Here
So
we will update
25
it.
into 75 will come here.
75.
Right?
120.
This is
And
the
then,
revenue part of it.
and then inventory
Now,
adjustment.
inventory part of it. Yes. So we are going to reduce the inventory with 25 into 50. Because we sold 50 books. Sorry, 25 books at 50. Right? Now this expense will come here as cost of goods sold.
Now COGS update.
Right?
We'll update the COGS, right?
Yeah, COGS. So that will be 25 into 50. Balance sheet tallies. Getting it? The matching concept.
Yeah.
Now, here is about a salary expense, you can say.
Okay.
Okay. So you've hired a clerk at 100 rupees per hour for 25 hours. 50% you paid in cash and 50% you paid later in Feb. So this is a very simple calculation. First of all, whether I paid later or today, can
It's an
I
expense.
recognize the expense?
Yes.
Right. So 25 hours multiplied by 100 is my salary expense out here. Okay. So expense has been recognized. Now 50% of it I've paid in cash.
So cash will go down.
Yes. So first I'll reduce the cash, which is 25 into 100 into 50%. So that much has gone down by that much has gone down by cash. Remaining I'm going to pay later, which is salary payable. Okay.
This 50.
So we can directly put 1250 out here and the balance sheet will tally. 1250 is nothing but 2500, 50% of it.
Mhm.
Okay. Now the subscription, remember we had got this 5,000 as 1 year subscription. And now finally the time has come to issue that first subscription. Okay. So let's come back here. Remember this unearned revenue? This unearned revenue was how much? 5,000. So 1 month's worth. Okay. Only 1 month. So divided by 12. Right. So 5,000 divided by 12 has now become applicable for us to actually issue it. So that much of it will be recognized as revenue and the unearned revenue will reduce. There's no transaction of cash involved here. Okay. So this will be
5,000 by 12.
5,000 divided by
12. Yeah. Okay. So no involvement of cash out here.
Can you just take me to this statement of unearned revenue in the transactions part?
Yeah.
So this unearned revenue of 5,000. No, the previous
The
entry.
first one.
Yeah, where we made this entry.
Yeah. This is.
Receive rupees 5,000 as 1 year magazine subscription to the monthly newsletter.
Yeah. Sorry.
So
we are saying that 1 month worth of subscription now we are issuing. We got it for 12 months.
okay.
1 month ka subscription, now we are selling it off. So we are basically earning now 1 month of it. Till now we got the cash, but we had not earned it. According to the accounting principles, we cannot recognize it as revenue.
This is what like I'm still getting confused here. So receive rupees 5,000 as 1 year magazine subscription. Me being the subscriber, okay, I have paid 5,000. Okay.
Right.
Now to the company from which I'm for example, Netflix. Okay. Netflix is giving me a subscription for 1 whole year. I have given 5,000 to this Netflix company. So the company will just put it as unearned revenue but they have already got the cash, right?
Yeah. So that is what the point is, no? That is where accrual accounting comes, no?
Okay. So like in the asset part, they have put the 5,000 unearned revenue 5,000. So we are balancing of the balance sheet.
Right. So
right?
Annually, since you are taking annual subscription, but let's say if you had taken it in the month of June. So your subscription is between June to June. But annual financials get closed in December for US companies. So half of your subscription would be shown as unearned revenue in your year-end annual report of Netflix.
Okay.
But the investor doesn't care. See, investor does not care only about your revenue. If he's getting cash, he's more than happy.
So here when it comes, okay, balance sheet part is clear. Like I have put my cash, I have increased my cash, I have also increased my unearned revenue. When it comes to the income statement, like every month I have to realize that one, right?
Provided that if you're making monthly and financial statements, no. Usually you make it quarterly. So quarterly you will recognize this as a revenue. As and when that is what is called as, see, there are two different. For example, software as a service.
SAS, right?
Right. So here you are taking subscription. Let's say monthly. And then software as a service, but installation. So there is something in IFRS 15. In fact, we had faced this ourselves when we had taken the Zoho subscription on whether or not, uh, you know, this would qualify as something that we can actually, the problem was of tax payment, TDS payment. So if the software is installed, then I don't have to pay TDS or any tax deducted at source, right? Now, there's a fine line of difference between these two methods. When software as a service is cloud, then you can go in the monthly part, right? And you have to only recognize 1 month worth of revenue. And as and when the people will keep on, resubscribing and they will keep on paying, the revenue will get recognized. So this is, monthly or yearly, whatever you want to call it, right? As the person uses, you will recognize the revenue. If the software gets installed in your system, so installation in the system hai criteria. Okay. Then you recognize the whole revenue. The whole amount for the year. So for example, if it is Tally, so Tally can be installed. And then if you're paying, let's say 15,000 for the Tally, the software, then Tally can recognize the entire revenue. But Zoho, if it is giving as a subscription, it can only recognize that monthly subscription amount.
Okay.
Understood?
There
are many more examples you can take. Microsoft, for example. Now, Microsoft 365. Now, Microsoft 365 is getting installed. And hence, even if you are paying, let's say, monthly, it can still recognize the revenue of the year. But now, if I am analyzing Microsoft's annual report, and if I see that the person is, resubscribing every month, but the company has taken the annual revenue, then this would be a red flag for me as an analyst. Because then my understanding now is that, okay, the company is very aggressive in revenue recognition.
Yes.
Right? So that's how it is linked. So as an analyst, why am I studying all this? Not to make this, but so that I know, what to ascertain from that, right? Every move of the company, in my mind, my analysis has to work that how is this affecting the company? How is this affecting the cash flow? How is this affecting the stock price? Right? So that's how you have to always, whenever you're learning CFA, you have to bear in mind that you're not learning this to do this all the time. It's not going to happen. But you're doing this so that you can make money or probably save money. Okay. The last part of it, I suppose. Okay. So now the investment portfolio, which we had put 50,000, remember? That has increased in value by 5,000. So, okay. So that includes 1,000 is accrued in the investment portfolio and the market value of the portfolio has increased. So, okay. So if I'll simplify this for you. So this 50,000 was a mix of bonds and equities. Okay. Stocks and maybe fixed deposit. Okay. So that the equity part of it has increased by 5,000. No problem. Okay. But the bond part of it has given you an interest income of 1,000. Okay. So any which ways, both the cases, we can increase the value of the investments to
5,000.
Yeah. First, let's increase it to 56,000. No, I'll show you. I'll tell you what exactly.
Okay, 1,000 and 5,000. Okay. Yes.
Yeah. Okay. 1,000, 5,000 here. Okay. Now the question is that if it has increased here, then it has to balance. Now, there is no possibility of any balancing out in the balance sheet. Because there's no cash. I have not withdrawn. I have not redeemed the capital. It is still in the portfolio account. So it will come as
Other income
as 6,000. Simply put. So this now we have understood how income statement is linked to balance sheet. Now, finally, we have to understand what is this great statement going to do.
Just one question in the last statement, right? If you go to the transactions, it says 1000 accrual.
Accrued means it is in the account. For example, interest income, you might take the option of getting the interest on your account or getting reinvested. Right? So if you are reinvesting, it is in the account. Usually you would prefer that so that you don't get taxation for that.
So this term accrual is, very like I get confused with this one. That's
This
why
accrued is not the accrued which we are talking about in case of accruals. Accrual accounting is different. Cash accounting is don't get confused. This is just a normal English term which is saying that it is accrued, collected
okay.
in the bank account on the investment portfolio. You don't have to worry anything beyond that.
Okay.
Okay.
Okay. That makes sense.
Now see. Now my question here is that is where you should be clear on the usefulness of each of the statements. Now you tell me. Now income statement is this. It is showing this. Balance sheet is showing this. How can someone say how much cash money did I make? Impossible. Can we say this revenue is reliable in terms of whether this is actually received in cash?
No.
Not possible. So now we need, since why? Because remember the big statement which we make. Statements are following accrual system of accounting, which means not cash, right? It is recognizing revenue at the point of sale or when the risk is transferred, right? Or when the contract is signed. There can be various situations. So whenever we are looking at the revenue, we don't know whether this is cash. So we need, because remember, valuation of a company is not done on income statement. Never. Because this is not cash. Valuation is done on cash flow. Or more precise, if you want to say, free cash flow. Okay, this also we will learn later in later chapters of the financial statement analysis subject. But valuation is always done. I'm not talking about the loss-making companies. I'm not talking about the startups. I'm not talking about all the gimmicks which are happening. I'm talking about in general scenario. Whenever we're talking about good companies, we're talking about free cash flow. Okay, and free cash flow has to be calculated through cash flow statement. So first you have cash flow statement, then you have. So free cash flow is not a statement. Free cash flow is the formula to calculate the cash flow to do valuation. But at the moment, what we're trying to do is we're trying to segregate this entire cash flow or business in three parts. First is all the cash flow related to operations. Second is all the cash flow related to
Investments.
Okay. All the cash flow related to finance. We're segregating. That's all we're doing. We're reconciling. Okay. And at the end, what we're trying to find out is how much cash should be available at the end of the year. So this is actually called, see, since we are starting with net income, remember? So we're not starting with revenue. If we had started with revenue, we would call the cash flow calculation as the direct method. Usually we never use the direct method because it is very tedious. Because at every transaction, I have to break down revenue and I have to calculate how much is received in cash, how much is not received in cash. So instead, the standard format of cash flow statement is to start from net income, ulta. So indirect method. That is why this method is called as indirect method. Usually this question will not come, but I'm just still telling you. Okay. So the idea is to go use net income and do a reverse calculation by reducing cash, adding cash, whatever it is, and getting how much money did we make at the operational level. See, at the operational level, if you see revenue minus COGS minus advertisement expenses minus salary, will give you some number on operating profit. But we are trying to find out cash. So let's link the net income first. So we are starting with net income of minus 3708. Now we start with directly in the income statement, which is the account or which is the line item, which is non-cash. Directly, you can see it.
Non-cash is depreciation.
Correct. Straightforward, you can see that the depreciation is actually not paid to someone. It is just an adjustment that we do
Calculation.
to spread out the costs. So since it was reduced out here in the income statement, remember we're trying to find out the operating cash flow, the real operating cash flow. Since it was reduced, we added back. Okay. We added back. So let's just link it. So we added back plus. Okay. And look at this other income. Again, this is also not received in cash, is it? Directly, we know that it is accrued in our, or it is collected in our investment portfolio, right? We did not receive it as cash. So whatever things directly we know that, okay, this directly we know in the income statement, this is not cash. So that is usually depreciation and amortization, other income, or let's say, gain and losses, which have been due to discontinued operations, all these things which you can directly figure out that this is not cash. Okay. Usually it is not that complex, but let's say. So we do minus. We are doing opposite of what we did here. So here it was positive. It was added. So we are reducing it in the cash flow statement. Okay. So this is the first part of cash flow statement. Always remember, we start with net income. We add the depreciation. And then we do some, if there are any other expenses which are not cash, we directly reduce or add it. Then we start with the working capital accounts. Whenever I say working capital, remember what I'm trying to mean, directly related to generating this revenue or, managing the business in general. So, we have to pay money to someone, we might pay late, we need to buy inventory, we need to have cash, right? All these things are related to managing the operations of the business. And see what we are trying to find out. We're trying to find out the changes in working capital. We're not finding out what is the working capital. Changes. Because remember, this is the account which caused this accrual to happen, right? Inventory. The reason why I have inventory account or I have accounts receivable account or I have interest payable is because I'm not paying cash, right? I have to keep tabs on whom I have to pay later, right? So changes. Now just remember this very simple technique. I will in fact write it down in the whiteboard so that you never forget. Okay, this should never be forgotten. Whether you are learning financial modeling or whether you are learning CFA, always, always never confuse on this. So whenever, whether it is in cash flow statement investing, so this is applicable for investing, operating cash flow, or financing cash flow, doesn't matter. Okay. Specifically cash flow statement only. So if it's an asset account, whether it is a long-term assets like fixed asset, car, machinery, equipment, or it's a short-term asset like accounts receivable, doesn't matter. So if it's an asset and we are trying to find changes in working capital or changes in assets in cash flow statement specifically, you always do asset as last year value minus this year. I'll give you the logic. Don't worry. Okay. And if it's a liability or an equity account, liability and an equity account, you do this year value minus last year value. Okay, now I'll tell you the logic. So if it's an asset account, let's say it is accounts receivable, and this is 2025 and 2026. If accounts receivable was last year 10, and if it is 20 this year, without using this formula, think about if the accounts receivable is increasing, does it mean that I'm receiving more cash or less cash?
Less cash.
Less cash. So that means I'm getting, if I just find the change, how much less cash did I get between these 2 years? 10. So hence your actual cash flow. So and let's say in 2026 itself, now I'm saying that you had a revenue of 100. Now, so you had a revenue of 100 and your accounts receivable increased by 20. That means it increased by plus 10. So how much less did you get in revenue?
Minus 10.
That means 90. So now you just use last year minus use. So this is the logic, but if you do 10 minus 20, you get minus 10. And all of these we are
Increase the
working
revenue.
against net income revenue, right? Right. So again, if we also use this against inventory. So last year's inventory was 50 and this year's inventory 100. Did we get more cash because of this? No.
Inventory increasing, so no.
Paid, right? So it is minus 50. You might also say that, yeah, but inventory is increasing, but it also does not consider the fact that how we paid it. Yeah, so that's the reason why we will also have accounts payable. So accounts payable on the liability side, if let's say accounts payable was last year 50 and this year is 0. So accounts payable has reduced, which means we paid, right? We paid, right? We reduced somebody, we owed to some supplier and we cleared the bills, right? That's why accounts payable reduced. Otherwise, accounts payable should have increased, right? So this year, which is 0 minus 50, it will give you a negative cash flow. If accounts payable increases, so then this is this year minus last year, which is plus 50. It's a positive impact on your cash flow. So when you're analyzing a company, you're expecting what? The accounts receivable to be low or the accounts payable to be high. Here, this would reflect that you have a good credit terms. People are ready to wait to get money from you, right? But people pay you instantly. There are companies, right? And you want the inventory to be low because so that things which you're making are getting sold. Getting it? So now you can apply this also to asset accounts. Let's say you had equipment. Go to the next page. So let's say you had fixed assets. Okay, so 2025, 2026. So fixed assets, let's say, was 500. And this year, your fixed assets increased. So last year minus this year, how much? 500 minus
1000.
So as a cash flow, you have invested minus 500, which will come obviously in cash flow from investing, but it still gives you the calculation very, very easily, right? Debt. So if debt was, let's say, 500 last year, and then it became 0 this year, that means I repaid the debt. So this year, 0 minus 500 will give you minus 500. So that's the
100.
cash flow, cash outflow,
Cash
right?
out.
Right. So the rule, just remember, and now let's go back to the Excel. Okay. So now inventory, since there was nothing before, we can always take last year as 0. There was nothing before, right? before this balance sheet creation that we did, last year's value did not exist. So we will take it as 0. So 0 minus inventory ending value, which is 46,250. Right? So negative 46,250. Accounts receivable is an asset account last year minus this year. So last year is 0. This year is 1875. So see how it is coming as negative, because we are actually not getting this cash flow and hence it is negative. Right? Unearned revenue is liability side. So this year, this is unearned revenue this year minus 0. Positive cash flow. Right? So although you were saying, right, we did not earn it, but in terms of the cash flow from operations, I'm happy. Who cares if my revenue does not show, but my cash flow shows? Right? Accounts payable is a liability account. So this year minus last year, positive cash flow. Salary payable, again, this year minus last year, positive cash. Interest payable, positive cash flow. Right? And now sum this up entirely. This will now give you operating cash flow, cash. CFO. Okay. Now let's come to equipments. Now in equipment, you just have to be a little more careful out here, that when you're dealing with actual balance sheets, never take the actual ending values of office equipment. See, because whenever in the balance sheet, you'll see fixed assets as being shown in this way. Fixed assets will be shown as gross accumulated depreciation, because every year the depreciation is getting reduced, and net fixed asset. So whenever you are taking values, so let's say this is 2025 and 2026, you 100 gross value might be there that you might have purchased the equipment. Let's say 50 was the accumulated depreciation, and this is the net fixed asset, sorry. Right? And next year, you purchased more assets. So let's say it was 100 plus 100. And the depreciation, let's say, increased by, again, 50. So whenever we are calculating cash outflow from investments in case of equipments, you want to do on the gross values, not on the net values. Just remember that. Okay. Because net values would have the complication of depreciation, which we have already considered in case of adding the depreciation here. So there will be a double counting, right? So only on gross values. So if I were to see the office equipment initially, we purchased for 10,000. So it would be 0 minus 10,000. Okay. Similarly, when we're talking about investments, initially we purchased it for 50,000, because the gain has already been considered in other income, right? And the gain in non-operating act will add separately. But initially, the investment that we did for mutual funds is 0 minus 50,000. Deposit is an asset account or a liability account. It's an asset account, right? So it was 0 minus 3,000. And this gain in non-operating act, why have we put it in cash flow from investing, is because it is related to investments. It is not related to operations. So we have although reduced it here, but we will increase it out here. Okay. Now let's sum this. So investing cash flow is negative 57,000. Initially, when we started the business, what was the contributed capital? 200,000. But remember, equity is in which side? Liability side. Right? So it is this year. So 200,000 minus 0. Positive cash flow. Right? Liability, debt. How much did we raise? 20,000 minus 0. This year minus last year. Add this up. This chapter of logic actually in the CFA curriculum comes very late. But I feel this first needs to be done. That's why probably this will save a lot of time for us when later on when we'll be at FSA. Okay. So now let's add up operating cash flow plus investing cash flow plus financing cash. Add all the forms of possible activities in the business, and then we get net change in cash. Okay. Now, what was the cash initially? 0. There's nothing, right? And then this change happened. So you get the EOP cash. So that's how basically the cash flow statement actually works. Getting it? Are we cool?
One thing I just want to ask, we are looking into the cash flow statements, right?
Yes.
For example, investment. Okay, I'm talking about investing cash flow. Purchase of equipment, purchase of investment deposit. Okay, this is where I'm burning my cash. Cash
Yes.
is going out of my pocket.
Right.
Okay, so this expense transaction is coming out as a negative number,
It
right?
doesn't matter whether it's an expense or not. What matters is whether you paid or not. See, it might come as an expense, right? But if it has not caused you to actually remove cash from your bank account, then it does not form a part of cash flow statement. No, it will automatically not come. You don't have to do anything.
Because
accounts payable,
hmm.
right? Accounts payable, although you have paid, in paper you have paid the expense, right? Or let's say you've got the inventory which you were supposed to pay, but you did not pay in cash, did you? You'll pay later. So that has got as positive cash flow. So it does not mean that you're getting this positive cash flow. See, cash flow statement is reconciling these two in order to give you a picture that, okay, in operating cash flow, you had a negative 20,000 cash flow. In investing, you had a negative 57,000. In financing, you had a positive 2,20,000. Right? And overall, from 0, the change in cash was positive 143,000. And hence, you cannot look at operating cash flow and make any statement about any expense that you are incurring out here. That's not what it is for. It is for reconciling. Right? If you want to make any analysis, then it is different. Then you have to go and calculate operating cash flow as a percentage of revenue kitna hai. What is free cash flow as a percentage of EBITDA, right? All of that is done at that level. Here we're just reconciling.
We are just looking at statement, how these numbers are put together.
Correct. Because here, if I were to give you EBITDA, operating cash flow out here, see, for example, here. So if I just put, so we can calculate EBITDA here, right? So see, so this would be operating cash flow for you.
Minus this, yes.
So it is giving us 2,708. But your actual operating cash flow just before this, because I think this adjustment has changed these values, but it's minus 20,000, right? So here EBITDA is showing is only 2,708. No problem. But in reality, your operating cash flow is way below. Right? So if you go to any, let's say go to screener.in and see how many companies are actually able to maintain good operating cash flows. Very few.
So way below, as in like operating cash flow isn't high over here. Like
Yeah, negative, no. No, negative. This is negative, no.
This is negative.
And here it is negative 2,708. So your income statement was actually showing a better picture, but in reality it is worse.
Yeah. Now this is what I was saying. Like cash outflow is much more than what I'm getting in.
Of course.
Right. So this is like, how was it?
And some cases it might be more for good companies.
Especially those ones which are growing rapidly, right? Like they
Not
burn
just growing, but see, a lot lot has to do with less to do with economic scenario, more to do with how the businesses have managed their businesses in the longer run, right? So you will see. So uh, how do I tell you? For example, you have Blinkit and you have Big Basket.
Mm-hmm.
In my opinion, I trust Big Basket more than Big Blinkit. Why? Because of the policies of the companies, which when you buy something from Blinkit, you always have a scenario where quantity might be an issue, or some form of cheating happens, right? You can't really trust the business. But when you see the Tata brand associated with Big Basket, you automatically have some reliability on the service. This overall, when continued over decades, right, uh, creates a certain trust in the market and certain reliability in the market, which guarantees sustenance of the business. So whenever
That is brand value branding, right?
yeah, brand value, and plus
It
so
is consumer perception.
yeah, consumer perception, and plus Tata is never, so something good to learn from Tata is the fact that they're never in a hurry to make money initially.
Ethical business.
Are very slow. They are into the very boring businesses, and they're not very fast. If you see a lot of startups, what happens? Everybody wants to earn money fast, and then they end up doing very crazy things, right? You start spending too much on marketing, you start hiring people above their pay grade, and then slowly, what happens? This accumulates, and what you see in the cash flow statement is just a result of it, right? So you'll understand more as you keep learning more. But for now, so we have not finished the second chapter. I think we're gonna take a little more time, but this practical exercise was required before we move forward. Okay, so in the next class we do that, and I suppose from the next class you will also there will be another subject which will start parallelly, which will be quants. Okay, the team will confirm. For now, what I wanted to do after this is, after going home today, is to do this again. Okay, just delete every transaction which you have done. Make a copy of it if you really want to refer to it. But I want you to do it again, and you will face challenges again.
Just for the reference, if you can send us the solution as well.
Yeah, absolutely.
Yeah, that
The
will help
solution
us.
is this only. I'll send this only.
Yeah, please. Just undo that change that we made. Maybe it does that.
Yeah, I'll do that. Okay. All right, guys. Thank you. I hope you understood. Let's catch up next week again. Bye-bye.
Thank you. Thank you so much.
Thanks. Bye-bye.
Alan, quick thing. Are we like
Yeah.
only a cohort of 4 or 5 people? I don't see joining in. In the last session, we had like 10.
No,
But
there are people, but they have exams. Actually, the MBA exams are going on in
okay,
Pune.
so like my cohort batchmates are like mostly from the classes. Well, am I the
No,
only
no,
one working
MBA.
professional?
Sorry?
Am I the only one working professional in this batch?
No, there are many.
Okay,
They
okay.
will come also. Don't worry about it.
Hmm.
And in fact, till the time you are actually getting this opportunity to be in
Yeah,
the
lesser the people,
lesser,
better
better
it is
it
to
is.
interact. Yeah,
Yeah.
because recently I was also doing in parallel this PMP course, right?
Acha, PMP.
Oh my God, like there were 150 people.
Yeah, exactly.
Everyone is a working professional coming from diverse
150, though,
backgrounds.
even if we had that kind of volume, probably uh, we will never do that way, because it doesn't make sense.
Hmm.
So we'll max our batches per batch. It would be somewhere around max 20, 25.
Oh, that's good. That's good.
Nothing beyond that. Even if we had, we try to split it up.
Even my wifey was very much interested for this one, but we have got a small baby.
Yeah.
So, so like, once I
Now tell
am,
her to join first financial modeling. I would probably prefer that.
no, I am also like very keen to understand this financial modeling course
And
because,
why are you not joining that? You should learn that. In fact, see,
I was
CFA.
I was in words with Anirudh. He said that he'll give me access to that batch. I don't know what happened.
Okay. Because I thought you have taken enrollment only for financial, sorry, CFA.
CFA was the thing, but then he said that he will give me access. I said, okay.
Acha,
So I
acha.
was waiting for him to confirm that.
Okay, okay. But this is a live batch going on for.
Oh, okay. I would love to be part of that live
I'll
batch.
tell you why you have to do that anyways, is because even if you write the CFA exam,
Let me switch on my camera, like just.
yeah, yeah. So even if you write the CFA exam,
Hmm.
uh, in order to get the results, there is now the new rule. I think 2 years back they started off the PSM module, the practical skill module.
Yeah.
So you will have to do it anyways. And see, this is just, I would say, probably just a trailer of what happens every day in financial modeling.
Hmm.
Because everything is practical and it really helps candidates to understand things more practically. So if you do that parallelly, it will be amazing.
Okay.
So I'll tell Anirudh to speak to you once properly,
Sure.
and then we catch up again.
So you are based out in Pune, right?
Yeah, yeah, yeah.
Where exactly in Pune? Because my sister has been there for very long. Like,
Kalani Nagar.
okay. She was staying there in. She was studying in Symbiosis, and then
Acha,
like now she's moving to Dublin.
acha,
Yeah.
acha. Okay, okay.
So like, I just like when I happen to be there, I'll catch up with you in person, or
Sure.
if you are coming to
And if you
Dubai.
have any other colleagues in Dubai specifically, because there is a cost benefit in terms of the prices for training. If
Hmm.
you have any people who want to join the CFA classes online, please let us know.
Sure. Like words of mouth, they always work.
Yeah, yeah.
So I'm looking forward to that. So, but anyways, like if you have anyone in Dubai, if you're just passing by,
Yeah,
let's
yeah,
catch
please,
up.
please. Please, please. Absolutely. Chalo.
Okay. Thank
Thanks.
you.